Hello everyone and welcome to the video on financial ratios and how to analyze a company using the same. So, commerce students must be familiar with financial ratios, right? They have been learning about the same for ages. Well, ever thought about why they are given so much importance? There are a number of ratios that can help investors assess the health and performance of a company. Ratios can help you compare a company's performance with its peers and identify potential areas for improvement. Ratios can also be used to gauge the risk of investing in a company. You may want to take a long or a short position in a company based on its financial ratios. You can use financial ratios to compare companies that are similar in size and industry. This can help you determine whether a company has a good or a bad financial profile. You may also want to use financial ratios to compare a company's performance over a period of time. This will help you to see whether the company's growth has improved or deteriorated over time. Now, let's look at some key financial ratios and how to use them. One of the most important ratios is net income to total assets. This measure shows how profitable a company is relative to its total assets. The ratio will vary depending on the company's industry or sector, so make sure to investigate the reasons behind why the ratio is higher or lower. The return on assets ROA measures how efficiently a company is using its assets to generate profits. A higher ROA indicates better financial performance. Now, there is something also called as ROE, which is return on equity, which measures how effectively a company is using its equity to generate profits and is an important measure of a company's overall profitability. The current ratio and quick ratio measure a company's liquidity or ability to pay its short term debts. The current ratio compares a company's current assets to its current liabilities, and a higher ratio indicates better liquidity. The quick ratio, on the other hand, measures a company's ability to pay its short term debts with its most liquid assets and is a more stringent measure of liquidity than the current ratio. Lastly, the debt to equity ratio and interest coverage ratio measure a company's solvency, that is, its ability to meet its long term debt and financial obligations. The debt to equity ratio is a measure of company's debt relative to its equity, and a lower ratio is of course better. The interest coverage ratio measures a company's ability to cover its interest payments by comparing its earnings before interest and taxes to its interest expenses. A higher ratio indicates better solvency. These financial ratios are usually easily available on most sites like Money Control. However, if you manually wish to calculate the same, you may use these formulas available on the internet and financial statements of the company readily available on their official company websites. It is always important to be completely aware of what you are getting yourself into while investing. And we at Spring Money, of course, are always here to help you. If you have liked this video, then do not forget to drop a like. To know more about finance and see more such informative videos, do subscribe to Spring Money. This is Sakib and see you in the next one.